So, welcome back. And today we're gonna be talking about the another chapter, okay, the start of the current issues, and this is the updated uh that we have for this year, that is 2024. Now, this chapter that we're gonna be talking about, it's the review of the Federal Reserve supervision and regulation of the Silicon Valley Bank. Now, it is, if I just take you to so this is the report. Okay. If you look at this is the overall report, the review of the Federal Reserve supervision. And this report is about 118 pages. Okay. So it's approximately 120 pages long. And I'll just let you know what the extract is, like what the thing is, and what are the key takeaways. I would highly encourage that after this particular class, I'll send this thing on the WhatsApp group as well. Go ahead, or you can go to the required ratings under the GARP website and you can check it out. So basically, the key takeaways, there are just like 2-3 pages that will actually highlight the important points that we are going to discuss. But moreover, let's understand everything from the basics. And I think once you understand these things, it'll just become very much easy for you to appreciate the language and everything that we have inside the details of the learning objectives. So let's go through it, and let's begin. So understand, we are talking about Silicon Valley Bank. Now, I hope, or I assume, that you know what Silicon Valley is. Silicon Valley is based out of US. It's there in the US, and it's one of the most every startup, they aspire to have office in Silicon Valley, right? So it's one of the most sought after locations when it comes to startups. So that's, or technology companies basically. So that's what Silicon Valley is. And the Silicon Valley Bank used to cater to all the large tech companies, or rather the startups that was there in Silicon Valley. So you can imagine the customers of Silicon Valley Bank was not, like a retail investors. Their major target customers was pretty much, large tech companies who had a lot of money. Okay, so that was the Silicon Valley Bank. Okay, now I have a little bit here. Okay, I'll just hide this thing. And I want you to pay attention. I hope that you all know what assets and liabilities are, at least for level two. So we have assets here, and we have liabilities here on the balance sheet. And here we have the equity. I hope that we all are familiar with this thing. Now, let's try to understand little bit about the assets and the liabilities of SVB Bank. Okay, remember, the target customers are large tech players, and the venture capitals. Okay, these are the venture capital are people who actually fund these startups. So if I want to run a startup, or if I want to do business in as a startup, I'll go to the venture capital, I'll borrow the money, and I will resume my business, right? So venture capital, they provide the funds. They are, kind of huge investors. We can just think about that. Okay. So now understand the balance sheet of this SVB bank, the large players. So understand the liabilities. We'll start from the liabilities, like where they are getting the money from. If you just pay attention to this, to the this 10-15 minutes in the very beginning, I feel that you will just get it. Okay, you don't have to understand everything, but this little thing is something that is very, very important. Okay, so same details I've taken from that particular ebook that we have. So understand the composition of the SVB Financial Group liabilities, and if you're able to see here, this this blue line, the dark blue line, the very dark blue line, this is the non-interest bearing domestic deposits. What do we mean by that? That means if I'm a venture capital, okay, I can invest or I can deposit, I can park my money in SVB Bank. Okay. And as you can see that the proportion from 2017 to 2022. Okay. So almost 5 years of data. Now look at this. From 2017, the deposits were pretty much in a decent spot. But then it started to increase a lot. So as you can see that, especially around 2020, it started to increase a lot. And you can see that. So this suggests one thing, that the deposits.
Yeah, no. I'm saying we can't take it. So I
Okay.
was hoping Gillette probably has.
Okay. So as you can understand, the deposits are pretty much increasing, and we can appreciate that the deposits are going up. That means the SVB bank, okay, they are getting money, like, as you can see that, we can say that from almost like $50 billion, they have grown to almost like how much? 220 something $billion, like from 50 to $220 billion. That's one thing to note. Now, what is the impact of this? Well, ideally, if you grow or if you have such a huge huge amount of money as your liabilities, or basically you're growing, so you are moving from a regional bank. So when it was $50 billion bank, the SVB, it was termed as regional banking operations in the US. But the moment they went from 50 to $220 billion within just like 5 years, or 4 years rather, it was termed as uh, LFBO, which is large financial banking operations. Now, within this 5 years, lot of things happened. Lots of things happened. Specifically, the supervision. One thing that changes is supervision. Imagine if you are a $50 billion bank. Okay, there's going to be some regulations. Okay, you will be seen by the regulators, but it's okay. Okay, but if you are a $220 billion bank, then the supervision level goes up. And specifically, that's what we call as large financial banking operations. And I'll talk about this later. But this is where the supervision was not done properly. The kind of supervision that was needed. See, when the bank is growing, that means they are getting more customers, more money. That means regulation should be there. A high level regulation should be there. Was it there? No. There was proper, there was some sort of supervision was not effectively done. And that was one problem. Okay. So that's the reason I brought this liability, so that you can see this thing visually, and you can see that, okay, from 2017, it started its operations, and it grew massively. It really grew massively, massively. So one thing is clear, it was moved from regional bank, like within region, to a multinational kind of a bank. Okay. So SVB focused on Silicon Valley, specifically for the startups and tech, but it also had one UK office as well. So it was pretty much moved to a large financial institution, a large bank. Okay, now look at this dark blue thing, and if you would realize within the liabilities itself that it's a non-interest bearing deposits. What do I mean by non-interest bearing? That means anytime I can put my money and I can take it back. It's a non-interest. That means it is 0%. That means all the venture capital you are paying how much? 0%. As good as 0%. Non-interest, no interest at all. But still, venture capitals, they parked their money within the SVB. And you can see the proportion. Okay, see the proportion that the 0% interest is nothing. I mean, like, you give me money and I can just give it out as a loan and I can earn out of it. Isn't this fantastic? Yes, it was. Now let's move to the asset side. I want you to focus now on the asset side, and I'll explain you the business model what the management thought about this. Just look at this thing and you will have, you know, you will have every idea about it. Okay. Before I talk about the assets, I want you to look at the deposit insurance. I hope that you are aware that in the US, almost $250,000 worth of deposits are insured. That means if I am in the US, okay, let's suppose that, or let's say you are a US customer, then if you go to the bank, deposit up to $250,000 will be protected by FDIC. Okay, it's an insurance. It's going to be insured. Anything above $250,000 will not be insured. So there is no specific guarantee that your deposits are insured. That's one thing. Secondly, if you look at this particular SVB deposit insurance, look at this. This entire dark blue, okay, this entire dark blue is uninsured domestic deposits. Uninsured. That means anytime anything happens to the bank, I have to be careful. The depositor, the investor, I have to be careful that, okay, my money is secure up to $250,000. And above that, I just have to take the money out from the bank. Now, why there was so much of uninsured deposit? Why? Because you know what? SVB Bank, I'll just let you some numbers. They almost had only approximately 37,000 to 40,000 customers. Can you imagine that? $220 billion bank, only few customers. Because all these were elite, like the venture capitals, the large tech companies. So obviously they did not have just $200,000 or $250,000. They had millions and millions of dollars, just to give you a number perspective, basically. And when this run on the bank happens, nowadays, I'll talk about the SVB bank as well, that when run on the bank happen, social media is very powerful. One post and everyone get to know about it. And earlier, in previous time, we used to go to the bank, stand in the queue, wait for our turn, and then take the money out. But in today's time, I can just take my mobile phone, I can take my cell phone, and I can just do the internet banking, and I can just take out the money from one account to the other. So that's the speed of, run on the bank. So when the panic happened with the SVB bank, I'll explain you what happened. But when this happened, this entire uninsured deposit, people just took out their money. And that too immediately. I mean, like, all I need to do is just log into my account and I can just take it out. With just one social media is very powerful when it comes to these things. Okay, so this is the liability side that we have seen. I've explained you about what is regional bank, how they moved from regional to large financial. That's one thing. Now look at the asset side. Look at the asset side. If I talk about the assets, they took this money and they invested in what assets? Okay, let's see that. So they invested in available for sale. So if you see this dark blue, dark shaded, this dark blue, this is available for sale securities. What is available for sale? That means anytime if I find a good opportunity, I will just buy it, I will sell it. Fair enough. I'll invest in certain securities. If I feel that the time is right, I can sell it. That's one thing. So it is kind of like available for sale is pretty much like a floating. You can imagine it's like a floater. It depends on the market interest rate, which is favorable. I can sell it and I'm good to go. But again, look here from this point to this point, the growth, basically 2019 to this point. What was their major asset? This thing that you see here, which is this held to maturity, which is a major chunk. What is held to maturity? Held to maturity is something that, for example, you can take it like a bond, okay, or a fixed income instrument. I will have to keep it up I will have to, keep that thing until a maturity. So a bond has a maturity, let's say 5 years, 10 years, whatever the maturity is. I will have to stick to it, and I will have to, wait until the maturity. I can just, and one more thing, you cannot transfer held to maturity to available for sale, or available for sale for held to maturity. You cannot do that. This is the accounting thing. It's not easy to transfer, like, when you're facing losses, you can transfer it like that. No, 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 no. If you're facing losses here, it's called as unrealized losses. It is loss, but it's called as unrealized. And when you just sell it, then you call it as realized. Okay, fair enough. So this was the available for sale, pretty much fewer. Majority chunk was held to maturity. And then these are like the loans and everything. And then this is the other assets, whatever the assets that you can think of. Okay, now at this point in time, I will introduce to you two other metrics that we will discuss going forward. And that one is net interest income. It is there in liquidity book as well, net interest income. Now think about it very logically. Okay, just think about it. You are a manager, you are a bank employee, and what would you do in this particular spot? Think about it. I am, as a banker, as a bank, I am paying 0% interest here, which is my major liability. I don't have to pay any interest at all. And I've invested in assets that are paying me certain percentage, let's say cumulatively 2%. Isn't this a money making situation to me? It is. I mean, I'm doing nothing. Venture capital, I've got huge amount of money sitting in the bank, like I have it. So my net interest income, which is nothing but interest that you pay here and interest that you get here, is approximately 2%. It's a pure profit. Pure profit. So the this SVB bank, what they thought is that, okay, we are into a sweet spot. We don't have to do anything. I mean, like, we are earning 2%. I mean, what else do we need? I'm just giving you one number, okay, just to have some clarity on this. So, and think about it. Think about it. I'll talk about this particular thing as well. So this was the net interest income. You will check it out later. We'll talk about this later, but I hope that you have an idea about this. Now, tell me one thing, that if interest rate goes up, is this a profitable situation? Absolutely. If interest rates tomorrow goes up, let's say Federal Reserve raises interest rate to 5%. What's going to happen? They don't have to pay any interest. And these available for sale and these loans or these others, they can probably earn higher interest as well. So rising interest rate was actually a profitable scenario for them. Okay. What about interest rate going down? Now, in this situation, if interest rate goes down, let's say 0.5, now their profitability is being hurt. Their profitability is now just 0.5%. So one thing is clear, interest rate goes up, they'll lose money. And other things we'll definitely talk about later, but I'll give you the idea about that as well. But their priority, I'm talking about the management thought process. What they were thinking is that if interest rate goes down, we will lose on the net interest income. So their entire focus was on net interest income. The interest we pay and the interest we get. We have to be profitable. But you know what? This is known as a short-term thought process. It's a short-term thinking, short-term profitability. Rather, they should have focused on economic value of their equity. So you have the assets, you have the liabilities. What is the economic value of equity? They should have thought about that. This taking, what's going to be the equity over 2 years down the line, 5 years down the line. That is what the thought process is. So economic value of equity is a long-term thought process. And this net interest income is a short term. You're just thinking about the interest rates. If it goes up, you make money. If interest rate goes down, the assets will fall down, and they are just paying 0% here. Just take it as an example, 0% here. Okay, so hopefully you are getting the idea as to what their liabilities was, what their assets are, and these are real numbers. Okay, these are all real numbers, the liabilities and the assets. Okay, so hopefully you have a context of what the management was thinking about the net interest income. However, the ideal thought process is to go for economic value of equity. Now, where things went bad, where things went bad. I mean, come on, it's a sweet spot. If interest rate goes up, okay, if interest rate goes up, I'm going to make more money on my investments. And you know what? They even had hedges. Obviously, interest rate risk management, you are a bank, you want to manage the interest rate risk, right? So they had hedges. And in fact, two hedges for interest rate up and for interest rate down. Now, obviously, their management, what did they thought? That our main priority is interest rate going down. We will lose on the assets, the percentage we give out on loans, and then we'll not make money. So they had hedges here. They had hedges here as well. And when the interest rates were actually rising, the Federal Reserve at that point in time were rising, they were raising the interest rates. And you know what they did? They removed this hedge for interest rate protection. They removed the up interest rate. If it goes up, will not face any losses. So they removed the hedge. That was mistake number one. Secondly, if interest rates were rising, why would a venture capital keep money here at 0%? I can park it somewhere else. I can earn some interest. So even they took out the money, and the interest rates were rising. And moreover, if you see, held to maturity was their major asset. Held to maturity. That means even if the interest rates were so held to maturity, that means let's say I bought a bond for 5%. Let's say this held to maturity was 2%. Interest rates are now 5% in the market interest rate. So isn't this a loss to me? I'm holding the asset which is 2%, and everyone is holding for 5%. Who will buy this 2%? No one. So the prices fall down. So they had faced, the assets were falling down. The these venture capital companies and everyone, they started to invest in 5%. The other banks, they moved out. So this was the overall crisis that they had. And as I said in the beginning, you cannot simply book losses. If it's a held to maturity accounting terms, you cannot do that very easily. You cannot do that. You cannot say that, okay, it's a loss, I'm going to just sell it and I'll book my losses. No, if it's held to maturity, you initially had the intention to keep it to maturity, you have to do it. There are only certain conditions under which you can do that. So overall, this was the major thing that we need to understand about the SVB banking crisis. Now, there are few things that we will talk about. One is the governance, what the board was doing, what the board of directors were doing. What was the role of a CRO? What was risk management? What was the management doing? Other thing that we'll talk about is supervisors. When the bank was moved from a regional banking to a large financial banking, where was the supervision? Why was it not done? That's it. Okay, so these are the things that we will talk about. Hopefully you have a context about the SVB banking. It's very interesting. I would say that you just need to know a little basics and I think you are good to go. So let's begin. This is the insurance. As I said, majority of their, majority of their money was deposits were uninsured. So, and as I said, in times of social media, one post and people just take out the money very quickly. I mean, I can send you a message, take out the money in just 5 minutes. You can just log into your internet banking and you can just do that, right? So that's what the thing is. Okay, let's start with the learning objectives, and now I think things will just make sense. So describe the events leading up to the failure of Silicon Valley Bank. So as I said, Silicon Valley, their target customers were rich, venture capital, large tech companies, startups, and everyone, right? Based out in Silicon Valley. And as I said, the customers were few as compared to large banks, but and the growth was phenomenal, from 50 to $220 billion in just like 4 years, right? So that's it's a massive growth. Okay, so what were the events leading up to the failure of Silicon Valley Bank? So first off, there was inadequate risk management. I'll talk about the CRO role later, but let's talk about this. So SVB board and senior management, they failed to manage their risk adequately. The bank's vulnerabilities, like they had poor managerial weakness, highly concentrated business model, like only to tech companies. I mean, come on, if I have 100,000 customers, retail customers, at least they know that their $250,000 is protected. But if I have a customer who has $200 million, $50 million, obviously he will take out the money and one customer is going to give me a hit, right? So it was a very concentrated business model and reliance on uninsured deposits. They relied on uninsured deposits. So this poor risk management left SVB exposed to rising interest rate, even though they would have made money in rising interest rate. But they removed the hedge. That was the first mistake. People took out their money because why would I pay? I'm getting 0%. Everyone is getting 5%. Why would I stick to this bank? No, it doesn't make sense, right? And a slowing technology sector, because one other reason was the technology sector was also slowing down in 2022. The tech sector was slowing down, and as I said, it's a Silicon Valley, major tech companies. So if that was slowing down, people needed funds, so they took out the money. That was also the situation. Okay, so inadequate risk management, the rapid growth without enhanced supervision. As I said, it was growing. Supervision was a problem. So between 2019, SVB assets grew from 71 to 211. Despite this expansion, the bank did not come under heightened supervisory or regulatory scrutiny. Why? Okay, so this lack of oversight also led up to the failure of SVB. What about governance and risk management? So SVB was consistently rated satisfactory in governance from 2017 to 2021. And you know what? If you read that 120 page, if you read that PDF, you would realize that the the overall approach that was actually used was a camel approach. Okay, so they, between that particular thing, if I just have to take you to this particular spot. Okay, so this was, so look at this thing here. So in terms of supervisory developments, they were pretty much, you know, so they were pretty much good. They were using this camel approach. I hope that from credit risk, camel approach is it looks at the capital adequacy and everything, right? It's there. So they use this particular thing for their supervisory. And this was, what was the rating? Well managed. So up until 2017, till this, it was well managed. And just in August, it was like not well managed. And this is when the crisis happened in March 2023, right? So this was pretty much the review, which is not decent in terms of the supervision as well. Okay, so in terms of governance and risk management, they were consistently rated satisfactory in governance from this period, despite repeated observation of weakness in risk management. And they changed some other thing. The management changed the stress testing assumptions. They did all the other things that we had. Okay, understand this thing. The board of directors, they did not receive information about risk. The board of directors, they did not receive any information about risk, like what is a major risk they are facing. And that is why they did not hold management accountable. They could not catch management. So that's something that you can just say for board of directors. And that led to ineffective oversight. So this ineffective oversight due to governance and risk management also led to the failure of SVB. And finally, ineffective interest rate risk management. Interest rate risk, the NI, net interest income, that's what it is. So SVB interest rate risk management was flawed as identified in several exams. So they did that exams of over a period of time, but it was found to be flawed but not adequately addressed. This deficiency became critical when interest rate rose and technology slowed down. So the management focused on short term profits, ignoring long term like economic value of equity. So they did not do that. That's what the thing is. What are the final days leading to the failure? Like how it happened and what were the final days that we had? Well, balance sheet restructuring and bank run. Obviously, when things go bad, what do? You ask for liquidity. You need working capital. You need money to survive, right? So what they did is they thought of restructuring the balance sheet. As I said, when the interest rates were rising, venture capital was taking out their money, right? They were saying that, okay, why should I stick to this bank? I can deposit somewhere else. I can get a high interest rate. So they started to roll out, these promotions, offers to all the venture capital. They started to raise some interest rate, right? But their assets were fixed. So there also they were facing losses. If I give you more, if I'm earning less, there also I was facing losses. So they started to restructure the balance sheet. And, when you always have this restructuring request, it can things, you know, people, the market sentiments do not take it very positively. And that's what happened. Now look here. March 8, 2023, SVB announced a balance sheet restructuring plan. This announcement triggered massive bank run. $40 billion was withdrawn on March 9 in one single day. That's the power of technology enabled, internet banking, mobile banking. And additional $100 billion was expected to be withdrawn the next day, leading to the bank's closure on March 10th. So just it took 2 days. That was a massive pullout of the money. So when this was happened in the final days leading to the failure. The other thing that we have is the deposit inflows and outflows. The SVB rapid growth was driven by deposit inflows from booming venture capital and technology. But as interest rate began, the bank faced significant deposit outflows. That was the final days that happened. Liquidity risk management weakness. See, in a bank, we have seen in 2008 as well that you need to have proper liquidity at your disposal. You need to have that, if you have gone through the liquidity risk book, you would see that 30-day cash flow, 60-day cash flow, 90-day cash flow, 1 year cash flow. You have to have all these things. And I'll show you one diagram for this. And their liquidity management was very weak. Okay. So they demonstrated foundational weakness in its liquidity risk management. Operational weakness in crisis management. So, when things go bad, operationally, they could not do it very well. So during its final days, SVB inability to effectively manage a crisis became evident that the bank had not prepared effectively for borrowing under emergency conditions. So they could not manage it very well. Okay, so that was something that we have for the first learning objective. In conclusion, the collapse of Silicon resulted from combination of poor risk management, inadequate regulatory, operational failures in a rapidly changing financial environment. Okay, moving on to the another learning objective. So there are few learning objectives, but I think everything will just make, it will fall into place now. Describe shortfalls and deficiencies in Federal Reserve's supervisory oversight. See, we are talking about the regulators now. What was the deficiency in that? So first off, SVB growth. So they grew from 71 to 211 between these 4 years. And this transition, that means they were moving from regional banking within a region or a community to the large foreign banking organization. So within the Federal Reserve, this shift meant now SVB was subject to higher supervisory and regulatory standards. So I think those two diagrams are pretty much all that you need to know, and you have the idea about this thing. If you just read through it, everything will make sense. So what was the key shortfalls and deficiencies in supervision of the regulators? We're talking about the regulators now. So there was delays in enforcement actions. They took time to, I'm the regulator. I should be acting, right? But the Federal Reserve took over 7 months to develop an informal enforcement action. They took time over 7 months to address the risk at SVB. And this delay was critical as SVB failed before the MOU was delivered. What is MOU? MOU is nothing but it's a document which states like what enforcement action will be taken. So there's an MOU. It's a document that lists out, okay, what action will you take? MOU. That's what the thing is. Okay. The second other key shortfall and deficiency in supervision was that inadequate experience and transition planning. Now think about it this way. When it was a small bank, the people who are managing, okay, and even the CRO, he was not capable of handling, when it moved from $71 billion to $211 billion, the CRO was not able to manage this large bank. So the CEO decided that, okay, the CRO will be removed and everything, and they actually removed the CRO. They actually removed that. So we'll talk about the CRO later, but overall, if you see that inadequate experience, you need experience when you are at this stage. You need people who have been at this stage, or who have a good amount of experience. That's what the point is. So examiners from the RBO portfolio, when you have a regional bank, people are working for a regional bank, they know about regional, but suddenly you move from regional to large financial foreign bank. Now you need this kind of people, right? So they RBO portfolio, they were accustomed to community, supervision, and they lacked experience with governance and risk management practices of larger, more complex institution. So the point that I'm trying to communicate is that when they were supervised by RBO regional officers, they were pretty much, at a regional level. They did not have the experience or governance to supervise a large bank. The transition, so obviously you will transition, right? You will move from RBO to LFBO. You will move. But the transition phase, when the time it takes for you to move, that is where the mistakes happened. So the transition to the LFBO lacked a defined plan and process, leading to a cliff effect, like falling down in supervisory approaches. RBO people said, we don't know how to manage, how to supervise. And to move here from here, it was taking time. So all this thing happened. So there was lack of supervision. We can say that. Okay, so getting the context of what we need to understand, okay, get the context. It's not difficult at all. This chapter, entire current issues is pretty much, if you understand it, if you know the basics, you will like it actually. Underestimation of risk and slow response. So the Federal Reserve did not fully appreciate the seriousness of the governance of SVB. They could not appreciate that. Their liquidity programs, interest rate, how they are managing the interest rate risk, they could not appreciate, and I think that was a problem, or the key shortfall and deficiencies in supervision. Fair enough. If you have any questions, please feel free to ask. That's what it's going to be. So there are some more shortfalls and deficiencies in supervision which we should know. Okay, which is the liquidity risk oversight. So SVB was subject to limited scope liquidity reviews, which were inadequate given its significant asset growth. Okay, and they had a unique business model, like only targeting elite customers, like the large tech companies or the venture capitals. So despite weakness in risk management, liquidity ratings remained satisfactory. As I said, the Camel's rating, the liquidity rating, that was pretty much remains satisfactory, even though there was many deficiencies. Policy and supervisory approach impacts. The board's tailoring approach in response to the economic growth. Now, this is another thing that was there in the US. Basically, there was some transition for the economic growth regulatory. This is an act in the US. Just need to know the basics that okay, uh, due to certain reasons, even the Federal Reserve, they were changing some of their directives. Like they were rolling out. See, they what is, if I just give you assumed example, think about it this way. Federal Reserves, they wanted to protect the globally systemic important banks, the large like JP Morgan, the Chase, all those large banks. So if someone is moving from a smaller to a larger, it takes time, it takes time. And there was some sort of a directive change as well and everything. So even that also uh, kind of impacted the supervision in the SVB bank case. That was also happened. So basically, I was focusing more on the larger GSIBs, not having little focus here. So that was one point. Resources, location, and staffing issues. Now, obviously, you need good people, good managers, good risk managers who can handle large portfolio like $220 billion risk. I can calculate VAR for like let's say $50 billion, but I cannot calculate or I cannot just appreciate or something for a $220 billion. So that experience that was pretty much lacking, and overlooking foundational problems. So during the growth in the RBO, the Federal Reserve oversight did not resolve foundational problems or implement stronger oversight. So we know that there was a governance problem. The board of directors did not receive much information, and that was a problem. Okay. So overall, it just belongs to those. Overall, if you just think about it, it just belongs to these key takeaways as I just as I explained in the very beginning. All you need to do is just the key takeaways, and that's it. So these are the key takeaways. If you just think about it, these are the four key takeaways, just 2-3 pages. If you read through it, you will understand. So I was talking about this, the tailoring approach to this particular thing. You will appreciate the content, and if you know what happened, you're just good to go. Okay, moving on to the next learning objective now. Okay, so the learning objective C, it says that Silicon Valley Bank's specific risk issues. Now, what is something that was specific to the Silicon Valley Bank? First off, look at the deposit concentration. Only venture capital backed technology and life sciences companies. So at a very nascent stage, that were more than half of deposits of SVB were from these sectors. So obviously, when you have such a, as I said, approximately 37,000 to 40,000 customers were there for the SVB bank. So you can imagine, like, only handful of customers, they can just take the money out and the bank is just gone. Other investments that they made for held to maturity. Significant portion of their assets consisted of unencumbered investment securities, with an increasing proportion designated as held to maturity. So this was problematic as interest rate began to rise, leading to deposit outflows and unrealized losses in the portfolio. Available for sale. This was pretty much not a huge investment available for sale, but they also experience unrealized losses in its available for sale portfolios, and that increased the pain even further. Contingent funding plan and capacity. What is the contingency funding plan? If things go bad, where will you get the money from? They did not have this kind of thing. So the SVB weakness in preparedness for a contingent liquidity event contributed to its inability to access contingency funding in times of need. So they did not have prepared for a liquidity, when things or contingency funding. When things go bad, where do you get the fund from? So no one just thought of giving the money to them. Okay, so that was another problem. And capital raising efforts. So when stress happens, everyone everyone started to, like, what they did is that the SVB bank, what they thought is that, okay, we are going to raise capital from the banks, they even started to give out federal home loan, FHLB, something like that. So they started to give out home loans under the federal scheme, something like that. So they started to all do all this thing so that they, raise capital. But that was also not successful in the case of the SVB bank, because it just took almost one day. When the news is out, within one day, $40 billion is gone. That's the power of social media and the internet banking that we have, right? So these are the specific risk issues that was just specific to the SVB bank here. Okay, moving on to the next learning objective: identify and describe the failures and shortfalls of SVB bank in the areas of governance and risk management. So in the areas of this, including those related to the CRO position and the bank's internal audit function. Now, this is interesting. Was doing, we know that the internal audit has to be, they have to be independent of the board and the management and everything. What were they doing? Let's look at this. And moreover, what the board was doing, the board of directors. So board of directors, they were insufficient. They had insufficient oversight. Why? They were not given information. They did not receive information about the bank's risk. So how can they understand that? How can they, ask the management, or they can just hold accountable the management that it's your loss, or it's something that you have done? There was lack of effective communication that led to the board's failure to hold management accountable for all this risk that they have taken. And even board prioritized short-term profits over effective risk management, often treating supervisory issues as compliance exercise. If something is supervisory, like you have to report to the regulator, they just assume like, okay, it's a compliance thing. So it's a compliance like that. Not good. Compensation packages for senior management was structured to prioritize short-term earnings and equity returns. That was a board of directors that we had. Let's look at the CRO. Now there's a lot of talk about that. 4 to 5 pages they were talking about the CRO position. In the case of SVB, the CRO failed to recognize the inefficiencies in the risk management framework. Ideally, governance, the board of directors, management, and the CRO, they all failed to recognize the inefficiencies in the risk management framework and the gaps that were identified by the consultant. So there was some third party consultant who came in and who said that, okay, we'll look at the bank, we'll look at everything, but even they failed to do that. Okay, so everyone was pretty much responsible at that point in time. But look at this, what is the importance of a CRO? So the CEO, he said that, okay, probably whatever the situation was, the CRO resigned in April 2022. April, he resigned, and a new CRO was appointed until December 2022. That means there was a gap in, from April till December. There was no chief risk officer. And this vacancy in the CRO role removed an important layer of internal oversight. So there was no one as a chief who can actually, guide the board, or who can, so important. That was an important layer of oversight, but that was not there. So this is one thing that we need to understand, that the importance of CRO. That's what this, and that's why you have it in the learning objective as well. If you just look at this, the CRO position, that's why it's there in the learning objective, because you need good professional people to handle the risk, or to understand and appreciate, or to have an oversight. That's what the thing is. What the internal audit function was doing? Well, supervisors found that SVB's internal audit department had also not provided appropriate coverage of the bank's readiness initiative or independent risk function. Overall, they was also inadequate. So everything that is there, they were also inadequate. Okay. And just to let you know on this CRO position, so there were some senior management. They were, if I do remember it correctly, they were managing the risk management until that point in time. There was no CRO. So they were managing that. So that you can imagine that. Okay. So that's something that we have it here. And finally, we have the last two learning objectives now. I'll talk about two things here, like the liquidity, like what was the liquidity scenario, and then the final learning objective, and then this chapter is done. Okay, identify the scope of Silicon Valley Bank's liquidity risk management deficiencies and shortfalls. So the entire focus here is on liquidity risk management. So understand, SVB demonstrated foundational weakness in its liquidity risk management. We know that liquidity risk management is very, very important. So what they did is that they did some stress testing. They did some stress testing on their internal liquidity, like what is a shortfall and so on and so forth. They did that. So the SVB bank, they developed and implemented, updated the internal liquidity stress test. However, the implementation highlighted weakness in the bank's liquidity risk profile. So if you look at this particular chart here, and you can see that so this is the time scenario here, and this is the time horizon. For overnight, the inflows were $23 billion and the outflows was $8 billion. So for one day, that was pretty decent, right? So they had liquidity. Operational shortfall was this much. Good, pretty good. But look at the 30-day. The inflows were $67 billion and outflows was 79. That means for the next 30 days, their outcome or outflows are very much higher. So it's a negative impact. So that means that's a shortfall. That's a shortfall. For a 90-day, it was again a shortfall. For a 1 year, that was pretty much decent. So that's why the learning objective also have this point, if I just hide this thing. The learning objective had, it's like the 30-day liquidity buffer, the stress testing of a 30-day liquidity buffer. So 30-day liquidity buffer was pretty much bad. I mean, like if you do the stress testing, you can see here as well. So as of July 2022, SVB was required to maintain a 30-day liquidity buffer based on the stress testing on internal liquidity. The reports revealed a significant deficit in the balance of highly liquid assets. That means 30 days, obviously you need liquid assets, but there was very less. As you can see the deficit here. But you know what? The management termed it as operational shortfall. They said it's operational shortfall. That was a situation here. So we know that there is a shortfall. Next, what we will see is how the management manipulated. Okay, how the management manipulated these things. So what the management said is that in terms of their when they were modeling this liquidity stress testing and everything, they changed the the assumptions, the stress test assumptions. That was a management response. They changed the assumptions, like, okay, take this so that we have to keep less money, when they were modeling the liquidity shortfall. The bank tried to increase funding and use less strict stress test. They did the stress test, but less strict one. Otherwise, what would you do? Like if the interest rate goes up to 100 basis point or 100 basis point down, what is going to be the impact? But ideal stress scenario is what? If interest rate goes up to 5%, goes down to 5%, that's an extreme. They did not do it. That was another point. Even management, they had concentrated deposit. We know that, okay, the bank deposit was only a few large depositors. Now, when it comes to modeling, they had inadequate sensitivity testing. So they limited sensitivity testing and lacked an adequate secondary function. So this was evident in the interest rate risk policy as well. And they had some, they even changed some unrealistic assumptions. When you do a modeling, you need some assumptions. So they did not appropriately consider key attributes impacting the reliability of liquidity buffer. So even they managed or manipulated these the assumptions. They did not look at correlation or the stress outcomes, and bank faced multiple deficiency, including a lack of assessing this particular thing. Like, so overall, I hope that you get the idea about that. If you just give it a good read, and I feel that you are just good to go. What is the supervisory oversight and regulatory consideration? Now, it's the same thing that we have discussed for supervisors, like what they did, why they were ineffective, they could not manage that, and all the other things. For supervisors, okay, the regulators I'm talking about. So supervisory weakness, limited scope approach to, and a lack of broader supervisory assessment contributed to missed opportunities for more evaluations. They could not do it properly. Same things, just what we have seen. Regulatory standards and expectations. The liquidity risk management were fundamentally flawed. We know that, but there are some other points that I've just gathered here from the PDF. Supervision. There was slow reaction to any vulnerabilities. Basically, there was delay in acting. Like what's wrong? Transition period leniency. You know that, as I said, from RBO to large financial, there was a transition period. So they were lenient about that. They could not do that. Liquidity was not seen to be very good. They could not, the stress test was flawed. Deposit was just going out. There was no high liquid assets, but still there was lack of supervision. Interest rate risk was not managed properly. There was a deliberative approach, like supervisors prioritized gathering evidence over timely action. So they were looking for evidence as against acting on the SVB bank, and initially well managed views. So that's just a good read, just good to go points. Okay, not you have to remember that. All right, and the last learning objective is the deficiencies in the Silicon Valley interest rate risk management process. Liquidity, we saw that the stress testing, internal liquidity stress testing was flawed, not good. 30-day buffer, not, they were lacking deficit on 30-day buffer. They did not have high liquid assets. They managed the modeling assumptions. They tweaked everything about that. Now we talk about the interest rate risk management, and this is nothing but the net interest income and the economic value of equity income that I just spoke about in the very beginning, right? So let's look at the overview of deficiency in the interest rate risk management space. We're talking about interest rate risk management. So obviously we know that the SVB exhibited fundamental weakness in its approach in managing interest rate risk. What was their approach? Well, they focused on net interest income. As I said, they were paying like zero, like non-interest bearing. So they were paying almost nothing on the liability side. But on the asset side, they were getting something. So their entire focus was short-term, net interest income. But that's a very weak thought process. So SVB's management focused on short-term view of interest rate risk management through the net interest income metric. They thought that, okay, if interest rates we are earning, that means our profitability is protected, everything is going good. So they had a shorter view. They did not think about a longer time period, which economic value of equity does. Now, this approach ignored potential long-term negative impacts on earnings. What is the real earnings? They did not focus that, which could have been highlighted by EVE metric. So such a focus led to lack of consideration of for idiosyncratic or market risk and the unique impact of rate increase on their customer base. They did not thought about that. What was the risk appetite statement? The board of directors, they prepare risk appetite in coordination with senior management. The bank's risk appetite statement, which was set by the board, included only the net interest income. That means even the board were thinking about the net interest income, not the larger view. Again, that's a problem. So this was a narrow focus that we have it here, right? So that's focus on this particular thing. So that's the first thing. The second thing is that weakness in interest rate risk policy. Look at the policy for managing the interest rate risk. The interest rate risk policy did not specify necessary scenarios for risk management. So as I said, net interest income, you will just take it like 100 points up, 100 points down, and you're good to go. Like see the effect and everything. EVE, it's going to be like 100 or 200 points up, 300 points up, 300 points down. You look at not just parallel shift, you look at non-parallel shift in the yield curve. We are talking about interest rate, right? So you look at non-parallel as well. But this was pretty much, they were looking only at parallel shift in the yield curve. That's what you will see in the report as well. So overall, they were not good scenarios for risk management. How the assumptions should be analyzed or how to conduct sensitivity. There was no guideline at all. There was no clear guideline on how limits were set. Like what is the limit interest rate? If it goes above this, how we will survive and so on and so forth. So this lack of detailing in the policy contributed to insufficient interest rate risk management practice. Other thing that we had was modeling and assumption deficiencies. So they, again, it's the same thing for liquidity. They worked out here as well. The SVB made poorly supported changes in assumptions, particularly regarding the duration of deposits. Now, what they thought about what they actually did is that they increased the deposit duration so that, they started to offer, venture capitals that, okay, you keep your money, our held to maturity or the assets are like, let's say for 10 years. So you keep your money with bank for 10 years. But that was purely a bad assumption that they actually had. So these changes were unsubstantiated and based on rapid increase in rates. Now, obviously the rates are increasing. If you hold on to a customer for 10 years, you give them 5% and you're getting only 2%, somewhere or the other, it's still a loss, right? So that was a counterintuitive modeling assumptions. You thought that, okay, I'm going to hold on to him. But see what you're getting less and you're holding on to a higher cost. That was a counterintuitive modeling. They removed the interest rate hedge for a interest rate up movement. So in pursuit of short-term profits, SVB removed interest rate hedges designed to protect net interest rising scenarios. Because if rates go up a lot, the asset value falls down, right? They will earn more, but the people also took out the money. So that was a two-way loss that they actually had. So they removed the interest rate hedging, which I said in the very beginning. All right. And finally, this is the last page that we have for this particular thing, mismanagement of EVE metric. The EVE breaches. So as we said that in this economic value of equity, it takes into consideration a lot of things. The interest rates going up to an extreme level, up and down, You look at the economic value of the equity, the earnings that you have. You're looking at that thing, and that's a longer term. You earn earnings, not just interest going up, this down like that. So internal reports indicated that SVB was in violation of its internal policy limits for EVE at risk, economic value of equity at risk, demonstrating a failure to manage long-term impacts of interest rate changes effectively. And there was a mismatch of duration. So there was a mismatch of duration of assets. Assets are for a longer period, liabilities for a very short period, especially uninsured deposit. I mean, I can take my money anytime because it's not insured. Otherwise, I would have kept my money in the bank. I wouldn't have worried about that, right? So that's the mismanagement here. But now, what could have been better? What could have been better? That's part of the learning objective. How proper use of metrics could have improved the management. So we are ending with this thing, which saying that, okay, how things could have been better. Well, probably, you could have used a balanced approach when it comes to, you utilizing the net interest income and economic value of equity. So rather than just focusing on short term, probably you could have focused for short term and long term as well, and that could have given you more comprehensive view of the bank's interest rate risk exposure. That probably would have helped, right? The second thing is that you could have done more scenario analysis and stress testing. You could have, you know you could have taken some more scenarios, some rather good stress test, extreme ones, and probably you could have managed your interest rate risk or liquidity risk, the deficiencies. You could have managed it in a better way, basically. And finally, the thing that was much needed was enhanced governance. There was pretty much needed, right? The enhanced governance and control. So regular detailed reporting of both net interest income and EV metrics to the board would have facilitated, I think, better oversight and strategic decision making as well. And obviously this is something that was pretty much needed. So that's what we have for uh, this the SVB bank here. And the majority is, this is something that you need to know. And if you're good to go with this, I think you wouldn't have a problem with this. So any question that you have for the SVB bank before we end up this particular session? Any questions? Please feel free, absolutely feel free to ask and get it clarified here.